Hello, mate. Here we are.
Oh, g'day, Mark. How's it been going for you?
That's all right. I'm confused.
Yep.
We got Warren Hogan's out there saying 3 rate rises.
Yeah.
Got old mates at Judo Bank. Good on them. I think CBA might have even come out there recently and said they are thinking there could be some rate rises. They might be starting to change their tune. By the way, I had Westpac in here only a couple of weeks ago on our Property Insights show, and they were saying no rate rises. So it's a bit confusing. Everyone's got a different view, and we've had some data. Everyone gets a bit nervous. Inflation numbers proving to be sticky is a new word. And if I can say something sticky, it's a problem. I think today you and I need to look at what the inflation increase number, what it's made up of. Let's just look at the absolute number. I'm not interested in that. Let's look at the items in inflation that have in the basket of goods and services, a lot of which are in services like insurance, like financial services, like childcare, like tertiary education and secondary education. Let's look at all those things, and there were some goods that went up too, but let's look at all those things and let's just pull them apart a little bit. What do you reckon?
I think that's a mighty good idea because I think just in the last fortnight, and in particular since that March quarter inflation number came out a week and a half ago, there's been this, as you said, a bit of a panic, I suppose you could almost call it. I've not seen anything quite like it. And just taking a step back before we kick into the gory details, the inflation outcome that we saw last week was only 0.2 above our expectations. It wasn't like a crazy result. And remember that the prior quarter of that, it came in 0.2 below expectations. Market forecasters occasionally get these things wrong. That's fine. But we had one that was too low, one that's a bit high now, but we've got this sort of outsized reaction. I think that's what we've got to sort of try to cut through, and why the market seems to be, just getting a little bit excited. When
outsized is a good idea. It's a good word. I mean, you're right. It's an outsized reaction.
Yes.
And I often wonder sometimes, you and I have been around long enough, mate, whether or not it suits the narrative of the individuals who are putting it out there. It gets a bit of a headline. It's quite possible it could happen. It's quite possible that we could get a rate rise. It's possible. But in terms of the realms of possibility, I see it as a remote possibility.
Yeah.
But we'll talk about, I'll get your opinion down the track. But let's just, we can look at your checklist a bit later.
Sure.
But let's hone in on inflation. Let's just
inflation.
So what changed? Everything changed inflation and everything either goes up or down. But what were the significant changes in inflation that you want to pull out?
The issue with that inflation number that we saw for the March quarter, the quarterly number, and as you said, there's a basket of around about 100 goods and services.
I think it's 90.
In there. It's about 90, but then they survey 100,000 prices each quarter.
Okay, let's talk about that.
Every capital city.
Kooky, that's important. I don't want anyone to think that they know every single goods and service, that even if it fits in their 90-odd categories, they know exactly whether they're going up or down. They do this through field work.
They do it through field work and increasingly a little bit of online judgment of prices. So in every capital city, including Canberra and Darwin from the territories as well as states, they have field officers go around and check the price of spinach per kilogram, a loaf of 700-gram tip-top bread.
They write it down?
They write it down. The cost of a men's haircut, a woman's haircut, men's shirts, women's shoes, and they put them all in. And as I said, each quarter it's 100,000 prices that they put into this almighty spreadsheet. I'd love to see it actually one day. And then they work out the change in the price of each of those items in each of the 8 capital cities compared to the price of the previous quarter. They also look at what we might call things that some people get carried away about, shrinkflation. So the price of something stays the same, but the packet of which it comes in is a bit smaller. So they take account of that.
So you buy a packet of Monte Carlos, and they used to be a kilo of it at $2 a packet.
Yep.
But now it's still $2 a packet, but you're only getting 900 grams.
Correct. They would take account of that and say that that's a 10% increase in the price of a Monte Carlo.
Yep.
So they do that. So they do adjust for those sorts of quality changes. Definitely. And at the end of the day, they put all these things into their spreadsheet, for want of a better phrase, and out comes the inflation rate. And it's as simple. It's as simple as that.
They do it for services too, restaurants.
And restaurants, yes, haircuts, insurance premiums, financial service costs. Childcare, doctor visits, dentist visits, rent, correct, dwelling rent, another big ticket item within the basket. And that's what they do. Airfares, things like that, hotel accommodation, which is a service, you just sleep in the room, then you go out, you pay your money, and that's it. So that's how the inflation rate is calculated. And when the economy is booming, the price of most of those things goes up by more than the Reserve Bank, and we would like, because of course that cost of living pressure is not good for anybody. When the economy is in recession, the people who sell these things tend to put their prices down or keep them steady because they're not selling any of it. Gee, if I put my price up, no one's going to stay in my hotel, so I better give discounts. Airlines discounting fares because they're not selling many tickets.
Which is the case, by the way.
Indeed. So that feeds into your inflation rate. Now, as you could well imagine, what's happening in the airline industry could be very different to what's happening in the beef and lamb industry, which could be very different to what's happening in insurance, different to schools, different to the whole basket of these items that they survey every quarter. So that's why you get some things going up a lot, some things being flat, some things going down, and it changes. The other thing that it can impact too is when, our friends in Canberra or the state governments put up the tax on a particular item. The classic one's tobacco. Again, I think it's about $40 a packet. I don't smoke, never have, but I know that the tobacco excise has gone up massively.
The tax on tobacco.
The tax on tobacco.
That you, the consumer.
And it goes up every 6 months.
And I think you should talk about the indexation.
And that happens to petrol.
Yep.
It's indexed. Happens to beer, wine, and spirits.
Tertiary education.
All this is indexed. Yes, tertiary education. So there's sort of like a built-in inflation upside momentum because if inflation's just say it's 3%, then next year the price of those, the index, the tax goes up by 3%, which is only a portion of the price of a bottle of wine or those sort of things. So, but it does impact on inflation. So they're the sort of things that when we say, well, hang on, you're not going to hike interest rates because of tobacco excise going up, or when weather events hit. I remember the lettuce prices in Lismore, the market gardens all got washed away, those horrible floods. The price of lettuces went to $10, and bananas, when that cyclone hit Queensland, bananas went to $15 a kilo. You just have to wait a couple of quarters, they grow back, and then they're back to $3 for a lettuce and $3 for a kilo of bananas. So that's why the RBA, when they look at this inflation rate, they want to keep it between 2 and 3% each year. That's their target, and they try to hit that. But they know that there can be the economy, the economic events that cause inflation to go up or down, like excess economic growth or very weak economic growth. But there's factors outside their control. Oil, petrol prices, it's gone up recently. The RBA could hike interest rates to, I'll be stupid for a minute, 100%. It wouldn't change the price of petrol.
Correct.
In the world or in Australia. So you've got to take that out of the
Does the RBA
equation.
take into account that? Does the RBA say...
yeah.
We are not going to hike rates because we can't affect that outcome?
Because we know petrol's gone up or down.
Yep.
Petrol's very volatile. They tend to do that, yes. They don't make it... See, this is the strange thing. They have what they call the trimmed mean measure of inflation, which takes out the things that go up a lot and the things that prices are the weakest. And they get the 70% of items in the middle of the extremes. They trim off the extremes. Now, that can be, I was actually reading something about this. The RBA is not completely happy with that. It's the best they've got. It's not perfect, but it's the best they've got. Because if, for example, you've just happened to have, and this is where seasonality comes in. So 1st of July, for example, the indexation of all these items we just mentioned, the excise, I should say, the tax increase take effect, then all of a sudden those items are going to be in the basket, then they're not in the basket. So in a sense, there's a case, and Mark, you'll remember this, the Treasury underlying inflation rate, that was in the late 90s, I think, where they deliberately took out everything that was impacted by government taxes. Fruit and veggies, it's a bit like the US core. It's excluding food and energy. Petrol, don't include that because we can't affect it. As I said, the RBA could cut, they could hike, they could do anything they wanted. The petrol price is determined by global events, and the Aussie dollar a bit too. But, you've just got to in a sense, occasionally at these times when you've got inflation at extremes, above target or below target, say, hang on, is this caused by demand? And I think if we look back to where we had that inflation spike a year ago, yep, it was post-pandemic. Everybody had a truckload of cash. The governments had pumped money into the economy, and it was only 2 years ago interest rates was 0.1%, the official interest rates. So, yeah, that's what caused that inflation blip, that spike. And here we are now. Where are we? And I think that's the big question.
So out of the last inflation read, which a lot of people got excited about because it didn't come back as far as it didn't fall at the same rate that they were hoping to, that they expected. What are some items in there that you might want to call out that probably perhaps that the RBA might just cast aside before the next meeting, just say, look, that's not a permanent thing. So, for example, under services, do you think they would want to adjust rent, for argument's sake, or rent would be something they would say, no, rents are going up.
Rents are going up, and they're going up because they are going up because of demand and supply. They might want to just downplay it rather than completely eliminate it. But in this one, and there was a couple of things that went down in price. So, for example, lamb prices were down 16%. Over the past year. There's an excess supply of lambs. I think farmers sort of slaughtered a lot of their stock because they feared a drought and all this sort of stuff. So lamb is cheaper. Now, interest rates had nothing to do with the fact that lamb prices dropped 16%. So it's a two-way street. You take it out on the down and the up. Petrol prices are up. We had insurance premiums up about 16%.
It was quite high. It was
extreme, 16% year on year. This year. It's not quarter on quarter. So this is through the year, 16%. And that's got very little to do with the RBA. It's because insurance companies are repricing for floods and risk and all this other stuff that's going on. And so you talk to anybody who's living in flood-prone, bushfire-prone areas. We had the big fires only, 3-4 years ago. So insurance premiums have gone up an awful lot, nothing to do with the RBA. Now, if you've still got to pay them, I still pay my insurance and think, oh my God, that's expensive just for my house and all those sort of things. But so it's still a cost of living, but it's not determined by the RBA. Things like tobacco, that went up 10% through the year. Not because, in fact, people are smoking less. It's a health policy that the government sort of put up the excise tax on ciggies to discourage us from smoking, and it's working. But the RBA is not going to hike interest rates because the price of cigarettes has gone up.
What about childcare?
Childcare, yes. Well, childcare, yes. Well, again, with the changes in the rules about childcare, and the government's trying to encourage particularly female workforce participation by making childcare more affordable. It is extremely volatile from quarter to quarter. It depends when a subsidy comes in or it drops off. Childcare was up strongly, and it's a government policy. And again, it's not really interest rate determined. It might be at the margin. So if your mortgage interest rates go up, you don't send your kid to childcare because you can't afford the childcare costs, so the childcare prices come down maybe, but I don't even think it's even that sort of stuff. It's those sort of services. Haircuts up strongly. Maybe you don't have a haircut, or you get your partner to chop your hair rather than going to a barber or a hairdresser. There are things that are sort of marginal in this whole process, which is why I think it's important to look at the things that are determined by demand.
Yes.
And determined by how much cash flow we all have. So that's why wages are an important determinant. So if wages are going up, we're going to spend. I'm feeling good. I've got a big pay rise. And that is undesirable if you're trying to control inflation. And so you look at all these things, and that's why there's so much debate. And that's why Warren's, good on him, God bless his soul, has got the 3 rate hikes in his forecast. But I do know, I think it was Westpac is still on a cut, but they pushed it back to November. I think ANZ back to November. I think they were calling an earlier rate cut. I think many people are still calling cuts, but they're sort of saying, no, it's way too early. It won't be till the very end of this year or 2025. And 1 or 2 people are saying, well, gee, we've got an inflation problem. But I wonder whether they're overstating some of these things that aren't interest rate driven in terms of their inflation effect.
So does it bother you that when the headline inflation comes out, and it comes out at what it came out recently?
3.6 annual,
and it's not decelerating at a fast enough rate, or at the rate the market expects, getting us closer to 3 or 2.5. Does it bother you that some places call out Oh, that's the end. We're now going to off the back of a headline number that we're going to start calling out rate rises. When does it bother you? I mean, technically, I'm talking about as an economist.
The impact on sentiment is huge.
Yeah.
Because again, those calls, the media love them.
Oh, totally.
If you say, "Oh, I think interest rates are on hold," you won't get any coverage.
That's boring.
And it's probably the best bet at the moment. But it's not very exciting. If you say, "Oh, 3 rate hikes and they've got a hike tomorrow and they've got a hike," the journos will come flooding to your door and they'll interview you. And again, Warren's a mate. He's a very good economist.
Yeah, no, he's a good economist.
But he is genuinely. But his profile has just been exploding this last couple of weeks with his 3 rate hike calls. And that's fine. But if everybody's reading that, seeing that, listening to it on the radio when he's got a radio interview, they're sort of sitting there all of a sudden thinking, gee, already I'm under the pump. We know that the 425 points of hikes that we've seen in the last 2 years are already hitting consumers.
Why don't you go out? You're an economist.
Yeah.
Why don't you go and say, this is rubbish?
I sort of have.
No, but actually get out and say it.
You've got to, mate, you've got to be polite.
Why?
Oh, I don't know.
Well, don't say it's rubbish, but
look,
send them away.
This is where the market comes into it. Because some people have dismissed that as, what the hell are you talking about, mate? You're barking up the wrong tree. And so the discussion on what markets are pricing in is actually the balance of his view, my view, their view, Westpac, CBA, Barrenjoey, whatever. And that feeds into this whole mix, and basically it's effectively no change in rates for the next 6 months, and there's still a small risk of one tiny little rate cut early in 2025. That's what the markets are pricing.
Early 2024.
Yeah. Yeah.
So you're early
2025, a rate cut, maybe 1.5. So 1 and a bit more. And so it is, but it isn't. It's a bit like the house price crash, doom and gloom people that came out a couple of years ago.
The Economist.
And good old Chris Joy, again, he's a mate. He's out there. But he came out, and Chris, if you're listening, I'm not having a go at you, please. I'm not. I've got calls wrong too, so have a go back at me, don't worry. But 30% calls. He had a lot of media coverage on that, and lo and behold, they've gone up 10% since he made that call. Fine. He said, I'm not having a go. But I blame the media, not the person making the call. That's fine, because the media want to cling on to extreme news. Dramatic news, and particularly if it's negative, because rate hikes, everyone gets nervous. House prices crashing, everybody gets nervous. Rather than saying, house prices might be sideways for 12 months, you're not going to get the headlines on the AFR.
So, anything else you want to call out from that headline inflation number? I mean, what would you say, Steve? Like, were you worried about it? I mean, did you think it's okay?
I think it's okay. Look, I think it is okay for a couple of different reasons. One, if you look at what the Reserve, now this is for the March quarter, the Reserve Bank only put their forecast for December, June. So if you've got to, interpolate the middle quarter to see where they're going. And it's broadly on track for what they are forecasting for the June 2024. Look, we don't get those results for just under 3 months. I think they're at 3.3. And if we get a 0.7 or a 0.6, I think we're down to about 3.3.
Yeah.
So it's sort of on track. It might have been 1/10 higher. And the other thing to remember, this is the thing that I look at. December quarter 2022, using the quarterly data, inflation was 7.8%. And then every quarter since then, it went to 7, 6, 5.5, 4.5, 4.1, and now 3.6. So the momentum is clear. If anyone just calls up a chart,
it's on the
CPI,
right trajectory.
It's on the trajectory. Now, maybe it should be quicker, a bit slower, but it's on the trajectory. And the risk is that just say we get the next quarter's number and it's lower than expected, and the RBA is hiked. Oh God, we made a mistake. We didn't need to hike because it's coming lower than expected because of childcare's insurance, lettuces.
Well, things just didn't reset.
Indeed, and that's or airfares coming down, and there's stuff that's happening out there that makes it. This is why we get the quarterly forecast inflation's wrong. Because we don't know what's happening to the price of a lot of the components. School fees, well, they'll be zero next quarter because they only get adjusted in the March quarter.
Yep.
And then they're zero for the next 3 quarters, and they get adjusted March quarter next year. So there's a few things that are saying to me that, look, I'd love inflation to be 2 point something today, but it's on its way there.
What was the quarter, not the year on year?
The quarter was 1.0, and that's the thing that's one.
Okay.
The previous quarter was 0.6.
Okay. What was the first quarter of the year?
The last quarter, because that was the March quarter, was 1.0.
So what was the first quarter? What was the June quarter?
It
last
was
year?
1.4.
Okay.
So if you look at the year on year, and this is why every year on year result for the last 6 quarters, a year and a half, has been coming down because it's been replaced with a lower one.
So so this is important. So because the the ABS looks backwards, the previous 4 quarters. So we're going,
correct.
March quarter, December quarter, September quarter, and June quarter.
Yep.
And if the June quarter was 1.4, if the next one we do, which will come out in July, we'll be dropping off
We're dropping off a 0.8.
Yeah, but we're dropping off 1.4.
Oh no! Sorry, we've dropped off the 1.4 for a 1 this quarter.
Okay, so we're dropping off how much?
A 0.8.
Okay, we're going to drop off 0.8.
And we know that we're going to. Westpac's preliminary forecast is a 0.6.
Right.
Now that might change, they might be wrong too. But the momentum is down. The one after that, we're dropping off a 1.2. Sorry to be.
They're big, but they're big though. They're large numbers.
They're bloody big. They're bloody big.
They're large numbers.
So just put it this way, Mark, to keep it really simple. Just say we get a 0.7 and a 0.7, which I suspect is probably a bit high because the economy's weak. If we get a 0.7 and a 0.7, all of a sudden we're at 2.9% by the September quarter this year.
Sweet spot.
The RBA would be thumbs up. They'd be doing a little handstand, and they'll say we can afford to sit tight. We'll look at other indicators. Maybe not ready to cut, but certainly no hikes.
So I therefore would say, before we go to your chart, I would therefore say the most critical piece of data that we're going to get in the next 3 months, 3 and a bit months, is going to be the June quarter, because we already know what March quarter is, we already know what December quarter is, we already know what September quarter was. We already know what they are. They've already passed. The most significant piece of information that people should be looking at is not what the inflation number is today for the last 12 months. No. It's irrelevant. What do we think inflation is going to be for the next quarter? And that's going to be the thing to determine, because I don't think the Reserve Bank is going to put rates up now. I think they'll wait to see if the June quarter indicates an increase in activity and aggregate demand of Australians. And I don't know how that could be the case because money has disappeared out of the system.
Mark, if I can butt in there, the day after the inflation number came out and everyone got a little bit excited, 2 days after, we saw the retail sales numbers, which were shocking.
Yeah.
Minus 0.4. And the Bureau of Statistics, not me, the Bureau of Statistics said in their top little commentary piece, year-on-year growth is 0.8%, which is outside the effect of COVID pandemic, is the weakest they've ever recorded. Retail sales, mate. So this is you and me and everybody listening, going out to the supermarket, going out to the cafes and restaurants, going out and buying, clothing and this sort of stuff. It's actually the weakest it has ever been outside the pandemic. And if you think about that for a second, think about, crikey doodly, that's pretty bad. It is fitting with this cost of living concern. The fact that people have been slugged with the mortgage interest rate hikes of the last 2 years.
And so rents and high rents.
Oh, and rents and all this other stuff, and insurance premiums.
That's 60% of the population.
Indeed. And so therefore you think, well, if you're a business person right now, am I going to be putting up my prices? I can't, because no one's going to come to my shop. And just by the way, sorry, I'm on a roll here. Coles came out earlier this week with their profits, Coles. They monitor the prices of their items in their fruit and veggies and detergent and nappies and frozen fish fingers and whatever. Their inflation rate within Coles was 2.2%.
Wow.
Now, okay, Coles don't sell insurance premiums. They don't sell rent. They don't sell the services, haircuts, that stuff that we were talking about a minute ago. Oh, they do sell lamb. So that you're getting your cheap lamb, and this is not an ad for Coles. And I don't have shares in Coles, just by the way. But they're sort of saying that what they're seeing in their I don't know how many items Coles sell, but you walk down the aisles, there's stuff from everywhere. Prices are only increasing by 2.2. So if that shows up in the grocery component of the inflation rate, which it will in coming quarters, the Bureau of Statistics go around Coles and Woolies and survey all these prices, that component's well under control. It's just these bloody services prices, as we said, insurance premiums, dwelling rent, that sort of stuff, tobacco, that are really causing the problem.
But there is a bit of weight sitting on those, of course, on those services, because a lot of people rent or build or whatever the case may be.
Yep.
But I agree with you. So, and by the way, I've been talking to some people doing the banks probably have the best information.
Sure.
They know what everyone is spending on their credit card. They know what everyone's spending on their check account. They know what their savings look like. They know where they are spending from, whether it's from excess money or wages or savings.
Yep.
And I think the banks are sort of indicating, as I understand, the banks are indicating to me anyway, not to me personally, but what I read from what the bank's indication is, again, similar to what Coles was saying, there is a massive flattening out in terms of expenditure, actual total expenditure.
Oh. Our mates at Westpac,
yep.
we've got mates in Westpac, they do this thing called the card tracker, where they look at card transactions, which of course is spending, and that includes services as well as your groceries, as well as your tickets to the footy and all this other stuff. Airlines, the Coles don't sell, and they're doing their card tracker. It comes out fortnightly because I think weekly it's just too volatile. So every fortnight they put out their little card tracker survey. It's pretty good at getting the broad retail spending numbers, pretty good. Flattening. Took a little bit of a blip up when Taylor Swift came out here. Yep. Even bought Taylor Swift tickets and, sequin dresses and all that other stuff for the go to the concerts. Bang, down. The one that came out earlier this week was really weak. And that would be for the end of April. The data for the end of April. We'll get, another couple of weeks they'll do their first half of May numbers. It's not the official numbers, of course, but their card data is showing that in addition to that officially weak March result for retail spending, minus 0.4%. April's looking crook as well.
And and if you look at the bankruptcies and the massive increase in business closures,
yep,
I'm predicting against Warren, our mates at Judo, I'm predicting that the June numbers, the July release, will be worse than the market expects currently. I got a funny feeling it's a lot worse than what our last number told us. And
the quirkiness in those labour market numbers is the other thing that I think's just sort of blindsided a few people. We had, again, a bit of a blippy, the Bureau of Statistics, again, not being critical of them, they do a great job, but they've had difficulty seasonally adjusting Black Friday sales in October, bring forward of sales from Christmas sales in November. December's really weird. It was weak. January, there's no January sales. And then all this stuff happening. So the month-on-month readings are really difficult and they're incredibly volatile. Plus 2%, minus 1%, plus 1%. They're all over the place. But if you put a trend line through them, take out the volatility, just put what is the trend, as we were saying a moment ago, it's very weak. And I think that is going to feed into a really poor GDP result. And, that's when you've got, if people aren't coming into your shop because people are hunkering down, they're saving, they're eating at home because they can't afford to go out, they're having a little holiday down at the south coast rather than jetting around to, lovely Queensland Islands or whatever, you're not going to be putting up your prices. You can't. You, in fact, might discount because I need to sort of get some cash flow. I'm going to discount my prices to get some cash flow. Well, and that's lower inflation.
My gut feeling is that's where we're heading. But
yep.
But you and I could be out on a limb on this. Let's go through your
your chart. GDP's into neutral. When we get the next quarter's numbers, by the time we convene again, it'll probably be onto the easing side. GDP is slowing. It's very weak.
When's the next GDP numbers come out?
GDP numbers come out in early June.
Right.
So they'll come out in about 3 or 4 weeks' time.
Right.
Inflation, I'm putting it not in the tightening range. It's on the cusp of going there for all the reasons we said. We won't go over them again, but inflation, a little too high, but it's coming down. The next quarter.
I'd like to see, but mate, I have to be honest.
What would you say?
Given what adjustments I would like to see, and given that we've had resets on prices, and some of these are just excise and taxes,
yes,
I'd actually put it back to neutral. But it's your board. We'll leave it at tightening.
And I will look at that. And while we're all hankering for that quarterly inflation number at the end of July, we do get the monthly numbers in between. They're not quite as comprehensive as the quarterly number, but they do provide a pretty good signal of what's happening to inflation.
Right, Labour.
Labour market, I'm putting there, same spot. Unemployment's just under 4%. Again, we mentioned that it's very volatile month on month. Employment growth has slowed. and the unemployment rate has gone up from where it was, but not worryingly at this stage. Now, having said that, all of the forward indicators, job ads, job vacancies, down, which feeds into this next one, which I'll put in neutral.
But can you, just before you go off labour.
Wages, yep.
Leave it there. So, but like, how can you reconcile that for me? Like, we've had this meeting a couple of times. So we've talked about seek job ads are down. Everything's down, right? Indicating that it's harder to get a job, okay?
Yep.
I know, everyone I know is not employing anyone or putting people off.
Yep.
There is record bankruptcies in terms of businesses. So lots of businesses close down. Businesses employ so many people. Yep. Yet the labour market seems to be strong. And by the way, we've also got huge immigration.
Who's employing those people?
Are they employed or not?
Yeah.
So is there something wrong in the numbers?
There could be. And in fact, it's there was an article in the Financial Times looking at the UK and the US have a similar problem. Not so much the US, but the UK and Europe. The economic numbers in UK and Europe are really poor, worse than Australia. So Germany's in a recession, but the unemployment rate's only gone up a bit. And they're wondering whether that huge population shift is causing the statistician, who, by the way, only estimates the unemployment rate. You know, the statistician doesn't go around, oh, you've got a job, you haven't got a job, you've got a job, or you're retired, so we won't count you.
It's not complete and accurate.
It's not complete. Now, again, it's an estimate, and over time, it tends to get it right. So I'm just wondering a couple of things, whether that huge increase in people has sort of distorted how they calculate employment, unemployment, or also there's a lag. And just by the way, I won't say who it was. I've had two meetings with some medium to big businesses in the last couple of weeks. One in particular said, the economy is very weak. I said, what are you doing to your staff? He said, well, I don't want to sack them yet, because I'm hoping that we get a rebound. But if we don't get a rebound by the third quarter, by the middle of this year, I'll have to let some people go. So there's this thing that we call labour hoarding, because it's expensive to hire and fire, you know. So
and we've all been through the process.
Indeed. And you sack, oh, damn it, the economy's picked up, I need to hire them again. There's this thing called labour hoarding. You probably ask them to work fewer hours. You don't give them a pay rise, can't afford to. But if the proverbial hits the fan later on in the year, my business is now genuinely weak, you let people go.
Yeah, so we might be in for a bit of a drama if things don't improve. I fear
that unless we do get an upturn, we're going to have much higher unemployment, which feeds into wages.
Yep.
In fact, we get wages data in about 2 weeks' time. Really important, because they are an important part of services costs. Yeah, the cost of a haircut's not, the price of scissors. It's the person who cuts it, and if their wages are going up, they charge more for your haircut. Yep. So, but for the moment, wages are neutral. They're not too high, they're not too low. They're Goldilocks, as they say. International economy, I'm putting it towards easing, because even we heard from the US Federal Reserve overnight, they've ruled out rate hikes. They've postponed the timing of rate cuts, but they're going to be cutting. In June, the European Central Bank will be cutting interest rates. New Zealand's got a sharp jump in unemployment. They're probably going to be cutting rates soon. In England, Canada, they're going to be cutting before the US, which is interesting. So the economies are so weak in everywhere but the US, and even that's weakening, that I'm putting international almost at easing. All financial markets are pricing in rate cuts. I don't think anyone is seriously pricing in rate hikes. Might be a few basis points, but everyone's looking further than that. House prices, slap bang in neutral. We saw the CoreLogic numbers the other day, 0.6% Australia-wide. That's fine. It's not too hot, not too cold. Perth's booming, 20% increases. Melbourne's off a bit, down maybe 1% in the last 2 quarters. Sydney's slowing.
Brisbane's up a bit.
Brisbane's doing okay. Hobart, Canberra, they're pretty weak.
So there's Adelaide, Perth are going away.
Adelaide, Perth going gangbusters. And that, you only have one interest rate for the whole country. Maybe Perth should have a different interest rate to Hobart or Darwin. But basically, they're fine.
But on house price, in those places that are going up at an extraordinary rate, what most people don't factor in is that there's an arbitrage going on. So people are going, well, I've got $1 million. I can buy 2 houses for 500,000 in Adelaide, where I can't even buy 1 house in Sydney. So and Adelaide's got 0 vacancy rate, so I might as well go there, buy 2 houses, and I'll rent them out, no problem, and I'll get the same rent. I'll get the same rental return as I would here in Sydney. And because Adelaide's going up, there's people are doing everyone's doing the same thing. I'm now going to get the capital gain. Before, you never used to get the capital gain in Adelaide.
No.
And now you do.
Now it's going up
because
really well.
It's on the radar. So it's an arbitrage game. That's what's creating house price increases across the board, because we are getting too much influence from too big a spike and too much influence in the averaging process for places like Adelaide and Perth. That's
Indeed. Lovely summary. Perfect. These next two, retail sales, we mentioned, shocking. Consumer sentiment, shocking. Consumers aren't dumb. They're smart. They know that their finances are being
Well, they know how much money they've got in the bank.
And how much they're paying on their rent, and how much they're paying on their mortgages, and how much they're paying just on cost of living. These other things too. Sentiments in the doldrums, building approvals, crap as well, pardon me, but they're rotten. We have construction companies, you mentioned which parts of the economy are doing poorly. Almost every day I hear of a small, medium, sometimes a large construction company going bust. Their cost pressures have been acute. The cost of materials, the lumber, the steel, labour shortages, and they're going bust. We're not building enough houses for that population. But we need to build more.
But that dreadfulness feeds back into house prices.
It does, because indeed it actually supports house prices. So this is the perverse thing from the RBA. And I got, Mark, I've had some incredible fights over this. I said, the RBA needs to cut interest rates to get house prices down. To encourage property developers to build thousands of properties. So you flood the market with apartments, houses, townhouses, because at the current interest rates and with current costs, I know property developers aren't going to touch it.
Look, they don't. It's too expensive. The margin's not there.
Indeed. Next item, business investment doing okay. And I'll put business confidence in that too. Maybe business confidence slightly towards easing. Business investment's doing okay, but the latest NAB survey of business conditions, business confidence, it had been resilient. It's now starting to tip lower as the economy slows down. So when we get the next NAB survey in a couple of weeks' time, I'd be worried if business sentiment turns lower. Because at the moment it's been more resilient than consumers. Consumers are feeling grim. Businesses are hanging in there, but it's just starting to turn. Commodity prices, I'm going to put them in almost tightening. The last month it's been amazing. Oil price went up, cocoa prices and coffee prices.
Ridiculous.
And olive oil. There's been weather problems in Spain and Greece, where they grow lots of olive oil and export it around the world. And so you've got some of these commodity prices, and wheat, as we mentioned, for bread prices. The conflict in
Russia,
Ukraine, still a part, obviously social and issues are horrible, but the economic effect is higher prices. So I'm putting commodities just on that side, not that you'd hike because of high commodity prices, but it is going to make it harder for inflation to come down quickly if oil stays at $80, $85 a barrel and these sort of things. Stock market, neutral. It's come off a bit as the interest rate expectations have changed. And current interest rates, I'm going to put that right over there on easing. They are restrictive. We don't need more rate hikes. As we've just discussed, we don't need rate hikes. It's just a question of how long they hold them. And they might think that, we need to hold them here for another 6 or 12 months. Or they might find that in September, we've got that labour market unemployment towards 4.5. We've got inflation down to 2.9. We've got things happening in the global economy, weakening. The Fed cuts interest rates. The Europeans cut interest rates. Then all of a sudden our RBA, we're not the Lone Ranger. We're part of the global economy. We've got different structure of our economy for sure. But if most of the rest of the world is cutting interest rates,
and we're
going to be part of the party.
Totally.
Just timing will be the question, and magnitude. How many rate cuts do we see?
And do you think Jerome Powell from the US Fed is going to be of any assistance, given his recent speech, saying that they will not be putting rates up, but they're not saying that they're going to put rates down either? But
I think that is very, very important to the RBA. Even though the market pricing in the US has changed, I think we started the year with 6 rate cuts priced in. Now there's only 1 and a bit priced in. So the market's been responding to changing conditions. But the fact that the chairperson of the Fed said we're not going to be I don't think we're going to be putting interest rates up. It's just a matter of when we put them down. my words, not his, but that's effectively what he said. I think that does give the RBA a lot of comfort to say a similar thing. We're not ready to put them down. No, we've got to see these things evolve. But if inflation comes down in the next couple of quarters, if that unemployment rate gets a little too uncomfortable for us, and if this weakness in retail spending, consumers and the like, puts a big hole in bottom line GDP, yeah, we'll cut.
I don't think they'll say it. I think they'll think it,
yeah.
But I don't think she'll say it. They're not, because you know what? These 1 hour conferences are nowhere near as open-ended as, more open-ended, or nowhere near as direct as the US Fed.
Oh yeah, the Fed. He gets a grilling.
He says what he thinks.
It's actually good sport.
No, it's good. I like it.
Some ungodly hour this morning, I was up watching part of it, and they give him hard time. Look, we've only had two of these press conferences with that new regime of the RBA and all that stuff. I think journos are probably learning how to be direct, without being rude. Or, But being direct, say, hey, RBA governor, what are you actually thinking about? When's that rate cut? What scenario? It could even be, what scenario does the rate cut feed into your thinking? What do you need to see? What's the critical number on CPI, inflation, unemployment, global conditions?
I'd like to see somebody ask those questions.
We'll stay tuned for next week.
But that's what we want.
Oh, we do. And look, they're getting better. I think the first one was like very... I watch it, and it is tough, and I'm not being critical of the journalists, but they're a bit nervous. You've got the RBA.
Well, what am I allowed to ask? Well, what can I ask? They don't know.
Something, but I think they're getting a bit more confident, and I know one or two of them reasonably well. I think they're going to be...
They should be seeing your chart.
Sharpening up their
They should be seeing your chart and listening to this podcast, mate.
I'll send it to them. No, mate, I'll send it out.
I'm serious. Good on you, Cookie.
Thanks,
Talk
Mark.
to you, mate.